In the short term, stocks are a popularity contest. In the long term, they are weighing machines. Remember this, this will never change. Once again, in the short term, stocks are popularity contest or a voting machine. In the long term, they are weighing machines. Before I get into this video, I want you to actually pay attention, watch this video. Price of comfort versus reward for discomfort that I did yesterday. I know Saturdays are not very popular days for people to watch videos. Watch these videos, okay? As one person commented on this video, this is one of the best videos that you ever made, even though I watched pretty much all of your videos. This video can change your life. Watch it. Now, let's move on to AMC. I made a few videos on AMC, and most notably, this one here, AMC stock, is it a buy or sell? So I made this video January 31st, 2022. January 31st, something like that, 2022. Yeah, the stock was about $15. Now it's 75% down. Less than $4, right? So I want to go down to some comments on that video because we can learn from it. So here we go. The stupidity of this guy is epic. It's not 30 million per theater. No company is worth just their assets. That one theater brings in 2 million per year times 1,000 theaters, 1.9 billion, and that is during the pandemic. Okay. No talk about a short squeeze. Trash. Nobody is in it because of the fundamentals. Nobody is in it because of fundamentals. AMC isn't a fundamental play. All this is invalid. So what I said in the video was that when the stock of AMC reached the height of $60, people were paying, the market cap was like 30 billion, and they had 1,000 theaters, something like that. And people were paying 35 million per theater. 35 million per theater, okay? So that's the fundamentals, right? And people didn't think that there was anything wrong with it because, as some of the comments said, it's a short play, it's a squeeze play, right? It's a squeeze play, and then from the top, the stock is down, almost 94%. So who did get squeezed here? Retail investors' brains or hedge funds? You see, fundamentals always matter. It might look like sometimes they don't matter. But at the end of the day, the stocks will eventually trade for what they deserve to trade. In other words, in the long term, the stock market is a weighing machine. In the short term, the stock can go anywhere as high as it wants to. And in the case of AMC, people were paying 35 million per theater. And then in the case of other companies, it can go as low as it wants to, no matter what the assets are, no matter what the prospects are. People can get so pessimistic that they will sell you stocks at valuations that don't make any sense. For example, if you listen to my interview with Nick about Voxter, he talked about New Vista Energy, right? New Vista Energy went from $9 to 30 cents, 96% down. And then from there, it went from 30 cents to $14, 4,000% return, right? So there was some macro things that hit it, but I want to focus on the one like in 2000 COVID. The stock went from $3 to 30 cents. Why? Because nobody wanted to hold oil. Remember, oil went negative and people didn't want to hold anything related to oil. So they sold it to you for whatever, and then eventually when things got back to normal, which the world needs oil, Vista Energy got priced correctly and it recovered from 30 cents to $14, which is a life-changing return, right? But again, in the short term, anything can happen on both sides. But eventually, the stocks will trade for the amount that they should trade. If the company is worth zero, it will go to zero, okay? And if we look at the long-term chart of AMC, I mean, in 2014, somewhere around there, the stock, 2015, the stock was at 35. And then it went from 35 to like 2 over the years, okay? And then, apes got together and they thought it was a great idea to send it from, $2 to $60, and they thought it was going to go to 1,000, right? They didn't think there was anything wrong with paying $35 million per theater, and so probably this drop from here to here was probably warranted because this business is not a great business, and I want to show you the cash flow statement, not the income statement, the cash flow statement over the last 9 years or so for AMC. So here we have from 2019, 2020, 2021. Cash flow statement, okay? So net cash provided by operating activities. In 2019, before COVID, it was, that number was $580 million. And then, of course, they got absolutely crushed. They lost more than $1 billion on cash flow from operations. And then 2021, they lost less, about $600 million, right? But I want to focus on the years that they actually made money to show you that even though they show they made money, they really didn't make any money. And businesses like this don't create shareholders' value. So if you look at that 580 cash flow from operations, right? And look at the line item below, 518, which is in the section of cash flow from investing activities, capital expenditures. Okay, so even though they showed a nice cash flow from operations, pretty much almost the entire amount went for capital expenditures. The whole amount, because this is capital intensive business. They have to, build the theater, they have to redo the theater, they have to redo the inside constantly, right? So all of the money from operating cash flow, it doesn't go to the shareholders. You can't use this money to pay dividends, to acquire other companies, to buy back shares. All of it gets eaten up by capital expenditures. Does this sound like a great business? Does this sound like a business that you should be paying $35 million per theater? Let's look at the other years. 2016, 2017, 2018. Same number. Let's look at cash flow from operating activities. In 2016, 431 million. Oh, what a great profitable business. Look, 421 went for capital expenditures, almost the entire amount. The next year, 217, 537 million of operating cash flow, 626 went for capex, capital expenditures, more than what they made. Next year, 2018, 523 million of operating cash flow, 576 goes for capex, more than what they made. Shareholders get nothing, no dividend, nothing. Everything has to go back to capex. Does this sound like a great business? The apes thought it was a great business. Now let's look at from 2013, 2014, 2015. Net same amount, 357 million. 260 of it goes for capex. The following year, 297 million of operating cash flow, 270 goes for capex. Then 467 million and 333 goes for capex. Now, does this surprise you that the long-term chart looks like this? It doesn't go anywhere. If you look at companies like Winmark Corporation, which by the way was in this book, Winmark Corporation, which is the Plato's Closet, used clothing, look at this chart. Look at this chart versus this chart. Do you think this is a coincidence? Do you think this is a coincidence that this company went from $10 here, 1995, to $250? Do you think it's a coincidence? No, it's because if you look at the financials of this company, let's have a look at it. Okay, so this is from 2019, 2020, 2021. Net cash from operating activities, 50 million here in 2019. How much of it went for capex? 169,000. Right? So now that money, how about the next year? 43 million. How much of it went for capex? 45,000. 48 million in 2021. 74. So because so little money goes to capex, because this is not a capital intensive business, they can actually build shareholder value. So what do they do with this money here? They took some of their money, like for 2019, and look, they invested 9,000 of it. They have another business, purchase of equipment for lease contracts. So they plugged it into other business by purchasing equipment that they can lease to businesses. That builds shareholder value. What else did they do? Did they purchase any stock back? Did they have any dividends? Dividends paid right here. Oh, look at this. They paid 3 million of dividends this year, 14 million of dividends this year, 33 million of dividends in 2021. Do dividends benefit shareholders? Absolutely. Do you think AMC paid any dividends? With what? With what money if everything went to capex? Did they repurchase any shares? Repurchase of common stock. Ooh, look at this. They repurchased 24 million of shares. Here they repurchased almost 50 million worth of shares. Buybacks. Here they repurchased 44 million worth of buyback. So do you think that this chart, the way this chart for Winmark looks, is a coincidence? That's because this is a fantastic business, and fantastic businesses do this for their shareholders, right? Do you think there's a coincidence why this chart looks like this? This is a horrible business. This here from 2 to 60 was pure stupidity, okay? And now even at this level, at $3 and a market cap of 2 billion, it's still overvalued. They're not making any money. They have a lot of debt. I still wouldn't touch it. I wouldn't touch this thing even if it was at 20 cents. So anyway, remember, In the short term, stocks can do whatever they want. They can shoot up to the upside as much as they want, shoot up to the downside. It's a popularity contest. During crazy days, people will pay anything for anything. They will assign huge valuations to crypto that's worthless. Clearly, they're not paying attention. During the recessions, they will sell you stocks for values that don't make any sense. Okay? It doesn't matter how valuable, what the assets are, they can sell it to you for whatever price. Like they don't even think about price and value. They will sell it to you. But in the long term, if you ride on the business, if you ride on the fundamentals, eventually the stocks will trade at a reasonable price, because in the long term, stock market is a weighing machine.